creative destruction. That's what capitalism does. It creates its own bubbles in its enthusiasm. It can't sustain it, and then it rolls backwards, and you get creative destruction, which is just a prostitution of Schumpeter. He said so much more. You can take interest rates to zero, and you can't get somebody to borrow money if they don't believe that they can earn a profit.
This is Little by Little with Andy Schechtman.
All right, welcome back, everybody, to another episode of Little by Little. Today, I'm thrilled to welcome Yra Harris. Ira is a renowned expert in global macroeconomics, a veteran floor trader of the Chicago Mercantile Exchange, and a former director of the CME Group, amongst other things. Ira, thanks for joining us. It's an honor to have you here.
Andy, this is great. I don't know where it's going, but I love things like this because
Ira, I don't know where it's going, but we'll figure it out. I'm glad to have you here for sure. It's an honor, and we'll just jump right into it. You know, I spent a little time on the Chicago Mercantile Exchange with our mutual friend, Joey Partipillo, but that was a long time ago, and that was before the open outcry, or after the open outcry systems, and something that always fascinated me. I would have loved to have seen that in person for sure. It was the handheld digital, not the screaming. It was still fun to be there. It was interesting to see, but not what it was when you were there. So I don't know. Let's just get right into it and say, what was it like on the floor in the open outcry system? Give me a story or two about what it was like being on the floor.
Well, it was phenomenal. The energy was phenomenal, and I'll give you a quick story. There was an artist from the former Soviet Union who came to the floor probably in around 1995, 96. His name was Alexander Belkin. And he came via a friend of mine because my wife and I had bought Soviet art before the collapse of the Soviet Union in the early 80s. I had an affinity for it because my wife. And so he came to visit on the floor. I couldn't get him off. I said, you got to leave it. Alexander, he says, no, the energy level, do you not feel it? I go, no, I live it every day. So yes, there were days he stayed with me on my shoulder for 4 hours. So that was the intensity. And I loved it because even though I was trading, the screens were I had the way I think and the way I move in the markets, I could do as well off floor with a telephone, phoning my orders into the desk and everything. But the energy level and the ability to feed off of that was just so contagious. I just loved it. That was the amazing thing. And you know what? You saw some of I would say 98% of the stuff, experiences was seeing the best in people, and people would talk about some of the bad stuff. It was a rarity for that. And people, yeah, you can shit on on anything that you want. Okay, all right. So, but unbelievable, and again, unbelievable the energy level, and it was really the greatest price discovery. And as the markets, especially the currency markets, where I started and really hung my hat and excelled at, and the interest markets, because the price discovery got so efficient.
Why was the price discovery so efficient in the middle of all of that chaos?
Because you had every bank in the world of significant import, and I mean in the world, would find its way down there. I mean, I did currency arbitrage. That was my first endeavor down there. Somebody hired me to run it and do it. So we went from 8-point wide markets in the currencies to half-tick markets. So in 1993, we closed the arbitrage because we couldn't make back, even though we were doing phenomenal volume, you couldn't make back your errors. And you were going to have errors. It's, amongst that chaos, you were going to have errors. So we said, there's not enough here to do it. But that was a testament to Leo Melamed and others who put this into action, how efficient the CME became at price discovery. I mean, it truly was unbelievable. Yeah.
I was going to ask you about Leo. I actually took it out of my questions. But I was going to ask you about him. So since you went there, tell me a little bit about Leo. Isn't he the person who invented the actual futures, the first contract that was ever traded on the CME?
No, there was already the meats were trading, but what he had the vision of was going to Milton Friedman and a few others at the University of Chicago after Bretton Woods ended, to say, well, there's going to be currency futures. And so, or there's a need for currency futures because instead of fixed currencies, there's going to be hedging. And because the dollar, the reason that Nixon on August 15th, 1971, pulled off the gold, the gold exchange standard, I think, is rightly called. That's what.
Right. You don't need a futures when you have a fixed contract fixed to gold. But in this case, once they became free floating, you needed an ability to hedge your exposure with the currency, correct?
Right. And that was that vision, with Milton Friedman, George Shultz. There was a great bunch at the University of Chicago who were certainly in favor of this. So Leo then, because he was the chairman of the exchange, or if not yet chairman, he was chairman, and put it into action. And with that then came interest rate futures, because everything became more volatile as inflation ramped up. So it was, and me, I was just in the perfect spot at the perfect time, because I was studying, I was in graduate school at the University of Wisconsin, studying political science and economy, and looking at the role of multinational corporations and the way they move money and third world debt. And so I was in the perfect spot. And a friend of my dad's who was trading, who was a meat trader, but all of a sudden he started getting involved in currencies. And I knew, he was like an uncle. He was more than an uncle to me. So he calls me up. He goes, "Your dad tells me you know a lot about currencies." I said, "Yeah, I know some." He goes, "All right, I'm buying Deutschmarks, but there's an election coming up, and write me a paper that I can understand this, to understand the implications." I did. It proved the forecast was right. So he calls me, he says, "Okay, you'll come work for me." I said, "No, I'm going to Washington, D.C. to work." I was going to go work on with the Frank Church committee on a multinational subcommittee on multinational corporations. It got disbanded, I think, in 1977, right when I left Madison in 1976. And he kept badgering me. He says, come on, I'm going to open up so after the third time, he said, "I'm not going to ask you again." So I came down there and worked. And it was just a great time. And I really have a great relationship with Leo. I still go to dinner with him 5-6 times a year. I just had dinner with him last month here in Arizona. Him and his wife, Betty, was lovely. But Leo had great vision. One person doesn't do it, but the vision moved people. And then all of a sudden it started to take off. And as I said, I still thank him. I said, "Thank you for the opportunity. I came in at the perfect time." And it really was. And currency trading was really just taking off.
Well, that's a cool story. You mentioned 1977, so you're right on the heels of Hunt Brothers. Tell me about that fiasco.
Well, we could talk about that, because in 1977, I went down to the conference that was held every year in New Orleans from James Blanchard. And
that conference is actually going on this weekend. I won't be there, but it's just to draw a parallel. It's still going on, and it is this coming weekend.
So when I was down there, I heard somebody speak, and then I introduced, and it was James Sinclair. So Jim Sinclair and I started with my mentor, my partner. We started a pretty good friendship that really grew over the years. And I would execute. He was not happy with what was going on at the COMEX with doing his metals orders. So he would say, "Will you fill my orders?" I go, "It's really not what I do, but if I can help you out." So I would fill his currency orders and gold orders at the CME. But it really evolved into a wonderful relationship for a number of years. Him and his partner, Vinny Teasy, who I haven't talked to in a while, but Jim, I think, died last year.
He did. He was a great man.
Yeah, he would. You know what? In the gold world, and he was always kind to me. I was writing the blog Notes from Underground up until really pretty actively until about a year and a half ago. Not then it's only sometimes, but he would cite me in his when he would do podcasts or he would write letters if he liked what I had to say, because he would respond to me. So we carried on for quite a long time in that way. But it was a great beginning and introduced me to the world of what Wall Street was about. Because I would go to the office at 90 Broad all the time to sit and shoot. When I would go out to see banks for business. So it really introduced me to Wall Street. I'm always thankful for that. Really, and I had a lot of respect for him and his dad, Bert. I mean, I learned a lot, and his nephew, John Crowley, who I still talk to. In fact, while I'm on, we'll probably get some, because we've been going back and forth all morning with various stuff. But I still talk to John, and he's still one of the best gold stock analysts that I know. I know Jim and John had a falling out, which was it happens in life. But it was an amazing run. But I was there. We didn't trade silver at the CME, but when the Hunts, and I can tell you this, that Jim told the Hunts that, he threw them out. He wouldn't do their business anymore. But Jim told them, stop doing what you're doing, because I think the phrase was, you're going to destroy the arena where everybody needs to come and participate, but you're going to destroy that through what you're doing. And
so they were buying contracts, realizing there were more contracts than bars backing behind it, correct? And then they were going to stand for delivery. Is that what, in essence, they were doing?
Exactly. But then, and they had hurt some of the fabricators because they were squeezing everybody. And so when they could no longer sustain the futures price, and the market sensed it, and it came out of Switzerland, because the Hunts tried to borrow money to sustain the position, but his margin requirements went up because of the volatility, and rightfully so. So they couldn't sustain it, so they had to go borrow money, because their sister, I believe, told them to get lost. She wanted no part of this. And then as soon as the Swiss said, wait a minute, you're going to pledge your silver for us to lend you money to sustain this? Well, this is over. So then there became a very active seller, I think, out of the bowels of Swiss banks. So banks that don't even exist anymore, but Swiss Bancorp was a huge player in the metals markets. I mean, they were great gold traders too. But once they got wind of they can't sustain a manipulation of the market, goodbye. And that's when silver prices just dropped. And the more they drop, the greater the margin call was.
So, Ira, you were the director of the CME group. You understand the rules of the exchange. And there are many people in my camp who believe that the metals markets are manipulated. Let's just cut right to the chase. And for a lot of reasons, without going down the rabbit hole, I guess I could say I do too, and I'm going to show you something in a moment. A lot of it has to do with concentrated positions. But let me just ask you straight up, in your mind, I guess we can debate what the word manipulation means, but are the markets or the metals markets, in your mind, potentially manipulated?
Well, so I will say, as a holder of CME stock, still owning seats, that my bias is, and I trade them actively. So I would say definitively not, and I can show you why I think that. And I still believe in the integrity. Are there things that sometimes make my mind go, what the hell is doing this? Especially because I'm a fundamental. I begin with fundamentals and then technicals go from there. So I always think that I'm pretty much understand the fundamentals, and I pride myself on understanding the fundamentals. And and I've heard the discussions about it. So here's my rebuttal would be, look, this market has changed dramatically over the last 35 years as to who the players are. So if I go back into the 80s, managing money for a guy who's phenomenally successful. I was running a hedge fund in 86, 87, up until into early 88. That was my first run at running a hedge fund. And he kept wanting to throw more and more money. We had 8, 9, 10 million under management, and he wanted to double to triple us in size. And I said, no, you can't trade that much money. How can I possibly do that? Worst mistake ever, because his name happened to be Paul Tudor Jones. And we managed Paul's some of Paul's money, and and that's what he would do. He would seed up and coming hedge fund, and he had just raised $100 million through, I think, Merrill Lynch did a Merrill Select, a Merrill Prime. And I said, Paul, so I wound up closing the fund thinking, I can't trade that big. What a gigantic mistake. So we've seen the change in it. And you don't have just, the hedge funds are not even the most enormous players today. They're sovereign wealth funds, which, we know Norway's over $1 trillion. And we don't even know how big the Russian sovereign wealth fund, and they're active players in the market. And to me, if you thought that you were going to manipulate this, the sovereign wealth funds could call the question any day that they wanted, because they could buy so many contracts and then stand for delivery and go, okay, show us. And if you can't,
I believe that we're seeing that, Ira. I do believe that the sovereign wealth funds are standing for delivery. We've seen massive outflows, not just on the COMEX, but also on the London Metals Exchange. But they're doing it in a very methodical way, as if it's thought out, to bleed dry the exchange rather than do, as you say, call it on the carpet, rather than do what Hunt Brothers did, make it in your face. It seems that through the cloak of the sovereign wealth fund, on behalf of whom? On behalf of a central bank or whomever it may be, it just seems that they're wise to that and are slowly draining the world's exchanges.
So let me go there. So they could do this. So we know that they could do this because they have the funds to do it if they wanted to, and they have the ability to create the headlines to push gold higher and higher and higher. So they could come at this from all angles. I know I watched the flow, the huge amount of gold that has flown, and Luke Roman and others have talked about it, that has gone from the New York warehouses, the London warehouses, to Shanghai. So there's no question. Is that manipulation? No, to me, that's the market. You want to keep creating dollars, and you provide the liquidity into the system, they will push it until gold goes to such and such a price that they will break the back. Now, can you then cancel the contracts? Yeah, that's under, and we'd have to open up, forget the CME, we'd have to look at the CFTC regs, right? And this is a very important issue. So can that happen? It can happen, but that would be, I don't look at that as manipulation.
Neither do I. That's not the manipulation either. That's just exploitation of the system.
Well, right. That's right. Because you keep creating the liquidity. Look, as I tell people say, oh, you're a gold bug. No, I'm not a gold bug, but I understand nothing would make me happier than gold going back to $41 an ounce, because then all would be well in the world. Okay. Well, but that's not,
and that'd be great. I'm all for it. Right. So here's the deal. That's the least of the arguments for manipulation. In fact, it's kind of the opposite of it, where the central banks are exploiting the manipulation by standing for delivery. Let me show you what I mean. I'm going to share my screen here with you. Can you see that? So I'll explain what it is in a moment. The CME allows for, as they call it, concentrated positions. They're allowed within the defined limits and under close supervision, as they say, but this balance aims to facilitate market efficiency while minimizing the risk of manipulation or excessive market power. Now, that doesn't make sense to me, I got to tell you, because if you take a look at the far right corner there, you see silver. You see a red line and a green line. The red line represents 4 Western commercial banks. The green line represents 8 Western commercial banks, the 4 plus another 4. And the point is that green line represents the largest concentrated short position on any commodity traded on COMEX. They are short 8 banks, roughly 800 million ounces, just a little bit less, which is a whole year's worth of production. So my question to you is, does a position that is that concentrated by 8 Western commercial banks, does that not seem unnatural to you when you look at all of the other commodities to the left of it, the tiny short positions they have? What goes through your mind when you see that big of a concentrated position in the tiny little market of silver?
Well, I look at it, so who are they representing? Because, I look at the prime broker system. So a lot of banks just leverage allow their balance sheet to be leveraged by hedge funds, especially. We know they rent that out. So our is the prime broker system using that? Are there short positions, which are, of course, evidently they'd be interesting because hedge funds are always, there's never just a single trade on. They're long, short. That's the way they operate. It's the way I trade. I'm not even a mosquito on an elephant's ass, so to speak, but it's the way that they operate. Now, you can say, are those central banks trying to hold it down?
You said it. I didn't.
No, because I'm not stupid. I understand that there are these allegations of it. Again, we don't know. We just don't know. And is the market, are there, abrupt movements? But I would say a lot of that is more to the high frequency traders thrown in now who operate on these algorithms, who are all keyword headline based. So you see ridiculous movements.
But is that not concentrated as hell right there? Does that not seem unnatural? Compared to, look at crude oil way down here. You got crude oil down on the bottom right there. And then way, 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 way up here. And it's interesting, silver, platinum, gold, palladium, the 4 largest concentrated positions. But I guess it's interesting, and we don't need to belabor this, but it to me, it is very interesting when you see 8 Western banks holding back the price the way that they are to this degree. It seems collusive. And that's part of the argument that a lot of people make. In London, those same 8 banks have between 4 and 6 billion with a B ounces short. 90% of those trades are naked paper trades. Question is, what the hell is so important about silver? And why do these banks, when countries like China, Russia, India are accumulating copious amounts of silver and gold, why would they be short to this degree? And isn't that manipulative? And let's frame that in the respect of JP Morgan paying a $920 million fine to the Justice Department, originally brought up on RICO charges, settled with spoofing charges. And a lot of people were upset that it like Ted Butler, that it was only spoofing charges. But isn't that, again, symptomatic of something where there's smoke, there's fire?
Well, so let's say there's China, right? Let's say there's China, and it's China dealing through an offshore account, because you could set up anywhere in the world today. So wouldn't it be in the best interest of China to call the question? China has far more assets than JP Morgan does.
See, no, I don't think it would be in their best interest to call the question, because they're the ones that are receiving the majority of the deliveries. China right now is flying around the world, buying up all the doré and the concentrate directly from miners in Latin America. They like the low price. I think the only reason they're not bitching, Ira, is because they're the ones, and the BRICS nations, that are accumulating it all, therefore exploiting the manipulation of the Western central banks. But at some point, maybe when there are no deliveries left, when no one is foolish enough to deliver at these make-believe prices, we see them become a little bit more vocal upon their disdain for manipulation.
Well, see, I'm a believer that China is going to create a central bank digital coin backed by precious metals.
Now you speak my language.
Okay. I believe that is going to take place because right now you can't get enough people to take the yuan as a currency because there's not enough trust yet, and I stress yet, in the government of China. Now, are others following? Yes, but they're waiting for China to make that, so when you talk about a central bank digital coin, and even Lael Brainerd talked about the Fed, she wrote a little paper. It wasn't a big thing, but she talked about it, that the Fed should create a central bank digital coin backed by a small amount of gold. Nobody puts a percentage on it. And I have a paper that's sitting, I have it right here, Andy, so you can see it. I keep it. It's from 2012. From the EC.
I talk a lot about Lael. I didn't know that she did that.
This
Even
isn't her.
Christina Georgieva, the head of the IMF, did the same thing. A CBDC not pegged to something as fiat. I talk a lot about her as a modern monetary theorist.
This is not her paper. This is a paper issued in 2012, September 2012, by the EU and the ECB. A more effective euro area monetary policy than outright monetary transactions, a gold-backed sovereign debt. This is the
BRICS had proposed a new settlement token, as you mentioned, the exact same thing you're saying, and the proposal they used was 40% gold backing. That's what the Swiss used to use prior to delinking gold from their constitution, giving them that little bit of monetary latitude. And that's to my point. And you're kind of playing right into the argument here that they need to have if they want to have a gold-backed currency or a commodity-backed system, as Zoltan Pozsar calls it, Bretton Woods 3 system backed by commodities. This is why the Chinese are not complaining, to your point, because they're the ones that are draining the system of the commodities that would then back this new system, and exploiting it against us by the leverage that the Western central banks are stupid enough to put on 90% naked short trades on the LBMA and 800 million-ish ounces short on COMEX. So I don't want to push you on the point of are the markets manipulated, but I think you have to think about it in the respect when you see that kind of concentrated position and then you see the metal flowing eastward, it just seems that maybe we're getting beat at our own game. Is that a possibility?
Well, listen, are we getting beat by our own game? To me, there's no question, because the more liquidity you create in the world, and we've seen this enormous, look at the Fed sitting on a $7 trillion balance sheet right now, $7 trillion. Not that long ago, it was 40 billion, and that was considered. So we've created massive amounts of liquidity in the system. I believe that. And I think that people really underestimate what that has meant and how you're going to resolve it. Listen, and this is not a political statement. Trump is coming in, and he's a debt guy. He likes debt. All real estate people like debt. It's the way they get to leverage up. I get to leverage up different ways, as you're talking about, but they get to leverage up, and they live on that type of leverage. So now they're coming in and the markets are going, yeah, you got a debt problem in the United States. And this is a serious problem. It's amazing that it didn't get a talk from either side during the election, because to me, that was the most important issue. So they're trying to figure this out. And it's interesting that he hasn't named a Treasury Secretary yet. Why? Because he knows now he's being told, and it's a very important issue for him coming in, and they're leaving him a mess about what to do with this debt situation. You can resolve it, and there's no going to, a couple of years ago, they cited this nonsense with Powell finding his inner Volcker. And I would blog about it going, inner Volcker. When Paul
raised rates to 5%, that's not very Volckerish.
Well, and you can't do it because when Volcker did what Volcker did, and I lived through that. In fact, it was really a coming of age for me to understand. I lost a lot of money at first because I really was struggling how far, I look at real yields, and real yields are always the driving force. And Paul Volcker took real yields to 6, 7, 8%. I'm talking about on overnight money. Long-term real yields, to me, don't mean anything. It's overnight. If you're trying to break the back of inflation, you need to raise interest rates to such a level that you're going to stop people from borrowing and you're going to slow the economy down. So there's no Powell finding an inner Volcker, because with the deficit, with the debt to GDP ratio of over 100, 105, 110%, you cannot raise rates to that kind of level. You cannot do it. You will send the globe into a global depression, and a global depression is what scares every central bank far more than inflation. Inflation they can deal with.
Does that mean yield curve control is in our future?
I think so. And that's not conspiratorial. We've gone that route. That's 1946 to 1951 with the famous Treasury Fed Accord. When, no,
it's not conspiratorial. Does it lead to unintended consequences?
Yes, it'll lead to higher gold prices and a much lower dollar. Now, I believe that the much lower dollar will not bother Donald Trump, because Donald Trump in 2017 to 20, the dollar dropped 10% in those, for various reasons. But Trump is not opposed to a lower dollar. And I'm going to tell you something. We have Bob Lighthizer, who I don't have to necessarily respect all his thoughts, but I respect Bob Lighthizer as a negotiator. He was intimately involved in the Plaza Accord of 1985. He goes back, he was in the Reagan administration, I think as an undersecretary of Treasury. You can fact check me, but he understands that. And he's concerned about it. So how this plays out, again, the only note I wrote down to myself, because everybody's looking at it, Trump is a transactional president. Is everything just meant as a bargaining position? We don't know. That's his past history and where his comfort zone is. But there's a lot that we're going to face here. And it starts with debt. Everything starts with debt, by the way. Every crisis in the world in economic history begins with debt. I don't care if you go back to Philip II in the of Spain, everything starts with debt. And when you get into a debt situation, and look at Rogoff. And Rogoff did an interesting interview with the group out of Switzerland back in September. And for Rogoff, he was unbelievably straightforward and really warning. I had to advise, read that interview. It's with a Swiss group. I forget, Marco Pipic, who I have a lot of, he just did an interview with the same group last week. So it's worth looking at. But Rogoff, and again, in 2011, they couldn't cite Rogoff and Reinhardt's book. Rogoff and Reinhardt's book was kind of like Marx. Everybody quoted it, but nobody ever read it. And he is warning. But Rogoff, way out of a debt situation, of course, was to run inflation 4 to 6% as if you could control it once you start igniting it. And if you look over time, and that's why gold continues to go up, because the world is very aware that the way out of this debt situation is through inflation. But more importantly, it's not inflation in my mind, because if you buy gold on inflation news, you're already late. Gold is a function. The price of gold is a function of central bank credibility. And central banks, while Wall Street wants to applaud them and tell me what a great job Jerome Powell did, I think I've been a detractor of Jerome Powell since 2018. But I'll tell you a better story than that. 2018, that he's been all over the place and really doesn't know what he's doing. So gold, which should not be going up when real yields turn positive. When real yields are negative, we got that move back from 1,100 back to the first move up to 1,900, because that's what negative real yields will do. But gold's been going up in the face, and this drives your point, because there's a buyer out there far bigger than what we know, because at 2% real yields, which are the historical rate, by the way, of if you look over 40 years, 80 years, real yields on the overnight money of about 2% is what the standard has been. gold should have gone down. In fact, I was looking to be a buyer at 1580 to 1620 based on some of my big technical work and numbers. It never got close, and it kept boggling my mind. I said, I have to trade from the long end, because when something ought to be happening doesn't happen, you better sit up and pay attention. And that's gold here, right?
Could it be the market's way of recognizing that the BLS is just BS, that the information that comes out of the BLS, in particular, the CPI, is just that, a lie? I mean, isn't that possible? Is it possible that they realize that we've embarked down an inflationary path with a debt burden that is growing at a rate that is unsustainable, and to keep the ball up in the air, you have to lie about inflation, and you have to actually talk about implementation of yield curve control, so that you have entities foolish enough to take our treasuries of any duration in an inflationary environment? I guess that's a nice way of saying it, but I look at it as, I guess that's how I look at the world, that how do we sell treasuries in an inflationary environment when, interest rates are going to be controlled to a level that maybe is far under the level of inflation?
Well, and again, so let's along that theme, and you'll go back to the Bernanke Fed, and what central banks, not just the Fed, because this is much bigger than the Fed, because we see what the ECB has done. So the Bernanke Fed, and Bernanke himself, again, was far more worried about deflation than inflation, because Bernanke's whole being, if you go back and look at Bernanke's research back of the 1930s, the United States cannot take a deflationary cycle. We cannot take unemployment rates of 20 to 25%. That is the critical element. And when Bernanke went, in Jackson Hole of 2010, the portfolio balance channel, that's what he came out with, August of 2010. So why? Because they wanted to elevate everybody's animal instincts, to go back to Keynes. That's right. Helicopter Ben. That's right. And that's because he feared deflation. They still fear deflation, even though the only country that's been in deflation is Japan. We've never had deflation. We've had disinflation, but we've never had deflation. So, and Bernanke did everything. QE1, Rick Santillana, when I used to be on with Rick all the time, we argued about it, that because he was opposed to it. That's the famous Tea Party rant. But QE1 was necessary to prevent a liquidation of the financial system. Now, if you're a Calvinist, you would root for the liquidation because great values, punish those who borrow too much, and reward those who saved and now have the ability to purchase things at lower prices. So that's capitalism. And I'm a Schumpeterian capitalist. Joseph Schumpeter is my favorite economist, and he said so many of these things right? Creative destruction. That's what capitalism does. It creates its own bubbles in its enthusiasm. It can't sustain it, and then it rolls backwards, and you get creative destruction, which is just a prostitution of Schumpeter. He said so much more. But he also said, you can take interest rates to zero and you can't get somebody to borrow money if they don't believe that they can earn a profit. Famous. But don't forget, it's an asymmetrical relationship, because I can raise interest rates high enough to break the back of your desire of entrepreneurial spirits.
Or maybe break the back of the banking system at the same time.
Well, it comes with it. But
are we trapped? Let me put it a different way. Are we trapped? Without having to lie or cheat or implement yield curve control, are we trapped? How do we get people to buy our treasuries of any duration in an inflation environment that we are in, and a president who loves debt, who wants low interest rates and a weak dollar, which decreases the purchasing power, which is by its very nature inflationary? Are we trapped? What's the way out, Ira?
You know what? It's going to be very interesting. And who's he looking at? And I have a book sitting here.
Judy Shelton, right?
Huh?
Judy Shelton?
Inside the House of Money, which was a project of Steve Drobny back in the, and I was proud, I'm honored to be part of it. But who's in there? But who do you interview? Because this is all about top hedge fund traders on profiting in global markets. So we interviewed Peter Thiel's in there. Scott Bessent is in there. Get the book for the $10. Help Steve. But you'll see who's in there. Jim Rogers, Dwight Anderson. It's a very, what I'm doing in there only because I was a floor trader and he didn't believe I existed. So he came out to interview me. He says, I know only because I'm in Chicago am I going to sit down with you. And then we wound up spending 2 days together because he really didn't believe I existed and that I could operate like this, trading on the floor, but with such a longer term perspective. But Scott Bessent is in there. Now you're going to have somebody who's going to have to deal with this problem. And we have a precedent to this, by the way. I don't know if you remember Fraga, who ran the Central Bank of Brazil, 1999 to 2002. He came out of the Soros group too. And it was a very tumultuous period in Brazil, but Fraga did a great job and then he stayed on. So you need people who understand this, and you should be rooting for people who understand it because it has gotten, the Fed doesn't understand. The Fed may understand it, but that's not what they're positioned for. They're positioned to ensure that the U.S. can sell its debt, right?
Well, right, but who was buying Brazil's debt, right? Was anyone buying Brazil's debt? Isn't it different when we try and sell our debt to the whole world?
Well, yeah, because the Fed has 3 mandates, and don't think otherwise.
What's the third mandate?
The dollar reserve status is their third mandate.
Okay. And
we saw that, right? What's the first thing that they did in 2020 in March as COVID started? And I wrote about it. You can go back and, in fact, 3 weeks before it, I said, they're going to have to open up swap lines, dollar swap lines to provide dollars to the rest of the world. That's the third mandate. Who you fooling? And that's exactly what they did. And now you have the standing repo facility with a big foreign, we don't even know what the level really is. They say 500 billion, but is open to foreign banks because the worst thing the world can go through right now is a dollar rally. The worst thing, because you want to talk about the dollar debt. Look at the global dollar debt. And as the dollar goes up, you have all these countries who have to raise dollars. Or raise their own interest rates to combat. And that's not even working anymore. We see right now the real is up at very high levels, 5.81 real to the dollar. And they have real yields of 8%. Real yields of 8%. Mexico, the peso's been getting hammered, for various reasons, but they have real yields. So in order for them to defend themselves against a stronger dollar, because a stronger dollar is absolutely opposed to their interests, they will have to raise rates. A stronger dollar is really detrimental to the global economic system right now. And the Fed has to be aware. If they're not aware of this and just raising interest, that's why they don't have the luxury of just raising interest rates. Because now we're on, all the algorithms that operate are working on a dollar differential. This is what I have to sit and work my way through. And gold is affected by it too. You see it all the time. You raise interest. The talk of raising interest rates sends things. Look what happened the night Donald Trump was elected, right? And 10-year yields rose dramatically.
Which is an interesting phenomenon too, Ira, because they've lowered into the front end of the curve by 75 basis points. The 10-year is up almost 90, and the dollar's up 6%. It's an interesting quandary.
Yes,
that we find ourselves in. Whoever is running the Treasury and Powell and whoever steps in a year or two after Powell, I think will find themselves in a very, very interesting position. All right, so
let me give you. So I had right up the Monday or Tuesday after the Brexit vote in 2016. And if you want to talk about stupidity, let's go back to what's his name?
Gordon Brown.
Gordon Brown. Thank you very much. Who sold off to all or 60 or 70% of Britain's gold in 1999. Now, that was an interesting time. And I will tell you, I tried to raise $100 million from banks to buy the British gold, some of it. I said, they're selling gold.
You would have been branded a legend had you been able to pull that one off.
Yeah,
at $250, the bottom ticket.
Right, 250 to 280. And then when gold really breaks out, I had a great technician that I paid for a number of years, and he was a great technician, Howard Green. And he presented me with a chart of gold in terms of euro that broke out above 325 euros to an ounce of gold. It was unbelievable. And that was like in 2000, 2001. And we laughed at when I went to, because I actually had some relations with banks, but they said, we're not going to lend you money to buy gold. We can do that ourselves. We don't need you. So why would we lend you money? And rates were low. So I couldn't, they were, and they said, why should we have you? We'll take the risk. We don't have to finance you to take the risk because we can't earn enough money. So, but I laughed about it because when they were selling it, and then that chart came live and you could see it. You can still go back and see it. 325 euros to an ounce of gold. So as I sit here, because I always keep gold in terms of every foreign currency futures. So right now we're at, 2,530 euros to an ounce of gold. So it would have been a pretty good trade.
I'd say so. I think you would have gone down. They would have had your picture in the hallway when you walked in.
Believe me, I had the trade on, but nothing like that. It was a huge. That picture is burned into my head.
Well, you're a fascinating guy, Ira, and you've lived it. You've been there. With that in mind, with all of the interesting circumstances, I guess you could say that Trump will inherit and his team. What do you think is the most critical factor that will shape the markets in years to come, kind of as a parting thought? How does this all play out to you? And, I know you're optimistic about the future, but what kind of pain do we need to go through, I guess, is really what I'm getting at. What kind of, some people say a reset, some people say it could be a depression, some people say it could be a bout of hyperinflation. What do you see as the chasm that we need to cross in order to get to the other side? What does that look like?
Well, first of all, I would start with, and I've been on this for a year, I said the best thing that could happen, and it's what Yellen and Brainerd feared most from the White House during the campaign, was a failed bond auction. But from a market perspective, the best thing that can happen to the U.S. is a failed bond market, because there's nothing like getting your teeth kicked in order to understand how serious the problem is.
So what does that look like? Does that mean interest rates go parabolic?
Well, you'll have a Liz Truss moment for sure, or back, to other moments that we've seen even in the U.S. But it would then let everybody know it's time to get serious. You can't look at, this. You can look at the equity markets and go, the equity markets make perfect sense when you overlay them to the fiscal stimulus that has taken place over the last 3 years. You have a Fed, even at 5% money, but with a huge amount of liquidity, because now they're reserve-based. Fed funds is virtually meaningless, except as a ceiling to operate against, but it's virtually meaningless because with all those reserves. And you're paying, up until 2008, the Fed never paid interest on excess reserves. You want to get Liz Warren going? You just talk about the amount of interest that the Fed pays out to member banks. We didn't pay interest. So the system was far different. That's why we didn't see the inflation that, as Steve Leisman would badger Rick, where's the inflation, Rick? Where's it? And I would laugh. I go, idiot, because the banks are parked. There's no velocity to the money because the banks are just parking it at the Fed. And even though they were only getting 25 basis points, it was far better than everything else going around it. So nobody was lending money because I don't have to. The bank said, we'll just deposit it at the Fed. So again, there was very low circulation. And then you had some of the better monetarists from David Rosenberg to Lacey Hunt, who were, talking about the lack of velocity in the money. So the best thing that can happen, this is just my opinion, have a failed auction. Let the Brainerd and Yellen, what did Yellen do? She front-loaded a lot of the debt offerings into the T-bill market because it's easy to roll the T-bills, right? That's not 10-year duration. That's not 5-year duration.
And that's why is that why they're pushing the rates down again, because those are coming due?
Well, you know what? That's what I think. So we've cut 75 basis points. Why did they cut on November 7th? To me, that was ridiculous. The election's over. They made a mistake in September, and Powell put himself in the middle of the election when he ought not to. They should have cut in July. And the fact that I agree with Dudley, and I thought so at the time, cut 50 basis and remove yourself, because if those, I was working off the Sam rule, Claudia Sam, with unemployment moving up, and it's their model. It's the Fed's model. Why didn't you cut in July? It was so stupid. Why would you put yourself in the middle of the election campaign? Okay, so then they cut again. And Powell says, well, it's because of the people we serve. And I laugh, because it's not because of the people you serve, because you're not serving the American population right now. You're serving the U.S. Congress, who has to deal with financing this debt. And we are way above the danger point, which is when the interest on the debt exceeds the defense budget. Because now you get into real issues of what discretionary programs are going to, if you have to cut discretionary programs, now the politics really begins to take place. You want to see arguments? Watch this.
Yeah, I don't think people realize that defense spending is discretionary. The Congressional Budget Office says that in just a few years, to your point, that all of the tax revenue goes just to pay mandatory entitlement, which is off balance sheet, Social Security and Medicare, and just the interest on the debt, leaving things like discretionary spending for military. You have to borrow for it. All right, so last question, I lied. Yeah, I'm your grandchild. I'm your grandson. And I say, Grandpa, what do I need to do to get ahead in this world? One piece of advice you would leave for someone, knowing all you do about the inner workings of the monetary system, the quandary that we are in with inflation and potential yield curve control. Where am I putting my money if I'm a young man trying to get ahead? What's that advice that you're giving to your grandson?
Well, first of all, my grandchildren are still young enough, but I tell them go get engineering degrees, because engineers run the world, because they're true problem solvers, unlike a lot of loviators who, and you could probably put me in that camp if you wanted to, but there are some who are better than others because they actually bothered to read economic history, and it's. You read Luke Rollman, Zoltan Pozar. I mean, these are people who I think are, one of my mentors who's been really great to me is Bernard Connolly, who wrote a book back in 1995 called The Rotten Heart of Europe, because we haven't even discussed Europe. You're U.S. and I understand that, but I'm doing a podcast later today with Daniel Lacaille, and we will be discussing, because I believe Europe is the most dangerous place that there is, because that could really blow up the world. And they have a debt situation without a centralized debt authority, no tax armament, but that's a different story. So I would teach them to be financially astute. Don't just give your money to anybody and say, here it is, manage it for me. That's not going to work. So first get your engineering degree. And I don't care whether it's petroleum engineering, whether it's gold, mine. If I had to do it all over, I would go through school and be a mining engineer, because I love that. I'm down here in Arizona. I love to drive up and to see Globe and other areas, Miami, where the huge copper mine. I love to see the equipment, and I love to see it, because there's nothing like moving dirt. to, finding out all these great things, and to be astute. And and not listen to conventional wisdom, because that'll get you into trouble. And I think, Andy, what you're doing, we don't have to agree. In fact, the greatest thing is that you disagree, because then if you disagree, well, let's find the points we disagree at and find out what I need to know more as to why you may be right. It's like every day when I wake up and I start my day here at 3:30 in the morning, I begin my reading with people I know I'm going to disagree with, because I know what the people I agree with think, and I don't need to be reinforced. That's only going to hurt me. I need to find out what those who disagree with me, what we think about, and why they may be right. Gee, entertain that. Why they may be right and I could be wrong here. Because as a trader, my first inclination, I've heard Druckenmiller talk about it and others, when I put the trade on, well, how can I be the only one to see this? I must be wrong. And then I establish my risk factor, right? I'm always, my first and foremost, any trader, if you're good at trading, you establish a risk. And what am I willing to risk, and why is this worth it? And again, you can be early, and I'm sure you have a lot of your viewers who are early in their views, good, bad, or indifferent. But if you're an investor, early is fine. If you're a trader, early is death. Because if you're early, being early is being wrong. And as you say, there are forces aligned against you who can really make your life miserable. So, and you don't want to endure that pain, because it throws you off what you do well. I see baseballs behind you in the thing.
Yeah, baseballs and baseball cards. Those are my favorite. I got all big mantles, and I probably just messed up my camera there, but yeah, baseball cards are something that I get more enjoyment out of than just about any other asset I own, including my gold. Who's that? Who's trying that?
Here you go. This ball, you will laugh at this. This is a 1938 National League Championship Cub ball.
Wow.
Now, this has a commodity story to it, because a guy who was a brilliant guy, but who went broke because his ego was bigger than his pocketbook, but a brilliant guy. His dad was the bookmaker in Chicago, but he was a big Cub fan, and he had this ball hand signed. And the guy owed me a lot of money because I would lend him money to trade, and you can't believe how smart this guy was. You cannot believe. He served in World War II with the OSS because he spoke in his house fluent Italian, so he was behind the lines.
Like Mo Berg.
Huh?
Like Mo Berg.
But this was an Italian guy, Frankie, and he gave me this. One day he throws a paper bag at me in the office, in Sinclair's office, where I was clearing at the time, and he says, "Here, 2 things we know. I'm never going to pay you." I said, and he said, "My kids won't appreciate it." He had 6 kids. He said, "They don't appreciate this. This is for you." So I still hold on to this ball. I mean, Dizzy Dean is on here. Gabby Hartnett, they're all on here. So Dan's Pay, they're all here. So it has a commodity story to it.
Boy, I like the confidence of a guy who walks in and says, 2 things we know. First, we know I'm never going to pay you. Second, well, what about, forget about number 2. Let's go back to number 1. Ira, I appreciate your time, man. Thank you very much for jumping on. And, just in saying goodbye, I agree with you more than you said about agreeing to disagree. I think that's been a big problem that people have, at least over the last 4 years since cancel culture reared its head. If you don't learn and you don't listen to opposing views, and you're married to your ideology, you learn more and more about less and less until you're an expert on nothing. And I certainly, and I knew you would push back on the manipulation topic as someone who earned his living on the CME and ran the CME for a little while, but I wanted to get your opinion. And I'm glad, and I'm appreciative of your candor You're a fascinating guy, someone I'd like to sit down with a bottle of scotch and hear some of the war stories. So if I'm ever Chicago way, you're in Arizona now.
No.
So you're in Arizona, right?
I'm going to see you in Florida. We're going to go to...
Good. You come on. Oh, that's right. You got family down here. When you come down, let me know. We will actually do that. And maybe we can pick up where we left off and record something in person. I'll just float that out there. But no matter what, I'd love to meet you in person and sit down and hear some of the floor war stories.
I will buy you breakfast at 3G.
Yeah, not far from my house.
And we'll bring a bottle of Johnny Walker Black, which my father drank. And
coffee.
It's a shit. It's not the highest of standards, but we'll get to that after that. So, yeah, I would look forward to it. And hopefully you will do another one of these if you want. Because I
look forward to it, Ira. There's nothing like learning from people who are actually there. And I appreciate your candor. I appreciate your time. And I wish you happy holidays as we include Thanksgiving here to you and your family. And yeah, indeed, I look forward to picking up where we left off.
And you know what? And someday somebody's going to answer my question about platinum. Because if you really want to see a market that, to me, that spread has gone from 1,200 premium platinum to gold to negative 1,700.
And let's remember this. Look at number 2 there. What is the number 2 most heavily shorted commodity on COMEX? Interestingly enough, it's platinum. So why don't we sit down and maybe that'll be the subject matter of our follow-up interview. Maybe even in person, because I live just a few miles from that restaurant. You come back here after drinking a bottle of Johnny Walker Black and see how it really goes.
Well,
that's real candor to our discussion.
And especially because it's Russia who produces 35% of the platinum. And I know electric vehicles don't use catalytic converters, but platinum is also a precious metal. I would argue far more than silver.
I would argue it too. It definitely has the same argument in relation to gold that silver does, or a similar one. Actually, platinum's used in a lot of the electric battery connective points, and there's platinum used in that too. But we will come back and pick up with platinum. I know you have another interview you need to do here in Europe, and it's getting a little bit late over there, so I'll let you run. But yeah, let's do that. Please let me know when you're down here, and we'll pick up where we left off.
And we'll thank Joey for making this possible. Thanks, Joey.
I love Joey, one of the greatest guys I know. Thank you, Joey. Thank you. But maybe we can have Joey come across the state and meet us too, which would be great.
Yeah, it would be great. Now, there's a few others too I'll bring along who are down there.
Hey, bring them along. The more the merrier. I appreciate you, Ira. Thanks again, buddy.
Thanks, Andy.
Little by Little with Andy Schechtman.